All right. Hi, everyone. My name is Lena Castanos, and I will be moderating today's webinar along with my colleague, Olivia. I will begin by introducing the Southwest Capital Pathways Program. Then I will introduce myself and give the word to our guest speaker, Blake Quesenberry, business advisor and CPA, who will introduce himself and take us through a presentation on small business on tax fundamentals. Feel free to ask any questions through the chat function through the presentation. We will be responding to them as we go. The questions that we cannot respond to in this webinar, we are happy to address through our no-cost one-on-one services or connect you to resources that can help. We will share a recording and slides of this webinar afterwards. This is part of our Southwest Virginia Capital Pathways program, but we do have a statewide capital pathways program that can take any clients from the state of Virginia. So we will be giving the information for both in the chat shortly. So what is the Southwest Capital Pathways Program? It is a program funded by the U.S. Treasury's SSBCI initiative, sponsored by the Virginia Department of Small Business and Supplier Diversity, and hosted by the Virginia SBDC and George Mason University. We can start with the program overview, then we will go through the program eligibility and finalize with its services. Capital Pathways is a no-cost specialized SBDC program that helps small businesses and nonprofits build the systems and habits needed to become capital ready. Why does it matter? Being capital ready matters because those less prepared self-select out or fail applications. Early failures correlate to lack of adequate capital. Higher cost alternatives don't build long-term capacity. Only half of requested amounts reach small businesses. To put things in perspective, about 25% of small businesses need access to financing for growth and preserving cash flow. However, just 20 to 30% of those who apply for loans actually get their loans approved. Capital Pathways creates a path for financial readiness. Our program offers immersive, hands-on group experiences paired with one-on-one support. Who is eligible? Very small businesses and nonprofits at any stage facing challenges accessing traditional financing. The services that we provide include financial skills and tools and loan application readiness. We start with an intake with our regional SBDC director that pinpoints your business key gaps so we can connect you with the right tailored resources, either through our Capital Pathways program or other resources that can help. We also offer financial webinars on topics including financial basics, financial statement preparation, accounting software training, and small business and nonprofit taxes. Another one of our offerings includes one-on-one individualized and tailored support on business foundations, profitability and pricing, financial forecasting, tax readiness and compliance, financial statements and tools, and financing options, loan readiness, and lender prep. Finally, our loan application readiness services include both webinars and one-on-one individualized support. The webinars are on topics such as what lenders look for in loan applications and SBA loan options. We also have a partnership with a lender that provides one-on-one support to those looking for capital. Again, this is our Southwest Virginia Capital Pathways program. This webinar is sponsored by this specific program, but we do have also a statewide program for those who are not in Southwest Virginia and would like to join us. So for our Southwest program, you can reach out to us through our email, which is swcapitalpathways@brceda.org. If you are not from Southwest Virginia, I will put the link to our website in the chat for you to have that handy. Now over to introductions. As mentioned before, my name is Lena Castanos, and I am today's moderator, along with my colleague Olivia Yarber. I have a professional background in economic development, small business support, and access to finance projects domestically and internationally. I am currently both a program lead and a business advisor in the Capital Pathways program. Today's session will consist of a 60-minute presentation. Again, feel free to ask any questions throughout the presentation via the chat function. We will be responding to them as we go. We will also leave some room for questions in the end. The questions that we cannot respond to in this webinar, we are happy to address through our no-cost one-on-one services or connect you to resources that can help. We will share a recording and slides of this webinar afterwards. Now I will give it over to Blake to introduce himself, tell us a bit about his background, and start his presentation.
Yeah, thank you, Lena. Yeah, we're going to talk about the tax savings here. Last week we talked about just kind of general tax filings, the boxes you need to check. So I had a feeling that we would maybe bring in some more people when we started talking about tax savings. So I think we got a much better crew here today, and I hope that you guys will be as engaged as possible. And feel free to drop some questions there in the chat, and I'll get to them as I can. And I would much rather spend this time chatting with you guys, talking about um, specific tax items related to you and ways that we can actually solve problems rather than going through this boring presentation here. But hopefully we can figure some good stuff out for you here. Like Lena said, my name's Blake. I'm a CPA, run a firm out of Bristol, Virginia that focuses on taking small businesses from 0 to 60 from a compliance standpoint, and hopefully finding ways that that can lead to capital, lead to improved cash flow, and things like that. So small business is where I spend 90% of my time, and I didn't plan on being too focused on tax. But once you dig into the weeds with accounting and bookkeeping and things like that, it is inevitable to there's a sorry. It's inevitable that it becomes a tax conversation. You know, as we develop the information systems, bookkeeping, things like that, feeds directly into tax. So tax has become a huge part of my firm. So today we're going to talk about uh, what I call the magic wands of tax savings and tax deferral for small businesses specifically. That's going to include uh, investment accounts, timed equipment purchases, making sure that all of your deductions and expenses are captured, mileage logs, all the fun tax stuff that you have to work on at year end. Hopefully, you've been working on them before year end. So we'll get started here. Tax magic wand number one. It starts with the processes for small businesses. Make sure that you're going to hear me say this a lot. Make sure that your information systems are in place. Make sure that your tax filings are accurate, and make sure that you are performing bank reconciliations on a regular basis um, to make sure that everything leaving the bank account is treated properly, and hopefully it's deductible. And if you are keeping track of that bank account and everything that's flowing in and out, you are much more likely to capture all of the possible deductions for you and save you money in tax time. We have a lot of folks coming in um, with a piece of paper, right? A piece of paper that has, revenue, and then they've got a few accounts there on the piece of paper, and it's obvious that they've just eyeballed it. As a tax preparer, that's really fun, because our job becomes easy. We plug it in, we take your word for it, we're done. But really, I see a massive difference with folks who have a dedicated accounting software or something like that, and they really track what's going in and out of the bank account. So those are the folks that seem to be much happier when tax time comes around. Not to prevent you from bringing in a piece of paper. If that's how you want to do it, that's great. But just make sure that you're digging as deep as you can and capturing all of your deductions. And that's also going to improve your chances if you ever get audited, right? So if the IRS starts looking at transactions and they see that you don't have these information systems in place, then they're going to more heavily scrutinize those transactions. So we want as much validity. We want those deductions to hold up. So make sure these processes are in place. Magic wand number two. I don't get a lot of folks that approach me about this. And that's kind of a bummer because I think that this is probably the most powerful win-win situation in the tax world, and that is retirement accounts for you as an individual, but also as a business. Um, a lot of the conversation, as you can imagine, starts with, "Hey, what kind of deduction can I get if I buy this vehicle or this equipment?" Um, I like to say, "What if I told you that we can we can defer and we can save an end of year tax liability, but we can also invest in an appreciable asset, invest in the stock market." That is a it's a massive win-win for business owners and individuals alike. So if you have the opportunity to invest in an appreciable asset and also save in tax, that's powerful. I would recommend that you look into that as deeply as possible. And there are a few different options here. And I'm gonna pause there and I'm just gonna check and look at this question here. Okay, so we have somebody that's specifically interested in SEP. Okay, and we're gonna dig into that. So hold that thought. I think we'll answer as much as we can here in these next couple slides. Um, and there's somebody in there that wants to approach me about retirement accounts. I will say that I will happily put you in contact with a qualified financial advisor, and we can kind of come at it from both sides. CPA plus financial advisor on this stuff is very powerful. Again, I would recommend it. Um, so let's dig into these retirement accounts here. Simple IRA, SEP, self-employed plan, solo 401k, and then kind of on the more individual blanket side, traditional IRA. So when I first put this together, I didn't include the solo 401k in this slide because I really haven't had a lot of folks that have gone with that. But I do want to talk about that first. A solo 401k, you're probably going to be better off going with a larger company to be your custodian for that. The reason that most folks stay away from the solo 401k is because there are recurring monthly fees usually. And if you're only contributing, five, $6,000 in a year, if you've got a $40, $50 custodial fee that comes out every month and you've got a market downturn, then those returns aren't looking too great once you bring out the fees. So solo 401k can be a great tool if you are planning to contribute, let's say, more than $15,000 in a year. Definitely contact somebody like Fidelity or the custodian of your choice. Talk about the solo 401k. And of course, that's going to be ideal for sole proprietors. Once we start getting into more employees, the simple IRA is very powerful here. Okay. And the reason that we want to specifically kind of put this in the bucket with businesses that have employees is that there isn't a required contribution that syncs up with your contribution as the owner here. There is a 3% dollar for dollar match for the simple IRA, or there is a 2% non-elective blanket contribution to all employees. So of course that is a cost, but it's not substantial usually if you're a company that's pretty good size and has some employees. Lower administrative burden on the simple IRA. That's important. Um, you're going to have a custodian there. A lot of your local financial advisors can kind of guide you through the process. They will usually have a company like American Funds or something like that who actually house the simple IRA, but local financial advisors can generally guide you through that process and kind of be the liaison between you and who is actually holding the money. Okay. So, and there's a 16,000 contribution limit for 2025, 16.5. So that's that's essentially just lowering your taxable income by $16,000. So, depending on what tax bracket you're in and things like that, that can easily amount to $3,000 to $5,000 off the top in your tax liability at the end of the year. Kind of the kicker with that one, you don't have a ton of flexibility as far as massive contributions at the end of the year. You've kind of got to, you can't contribute more than your salary, right? So you're kind of best off ramping up that contribution throughout the year instead of saying, hey, I'm going to dump a bunch into this at the end of the year. That's just generally not possible with the simple IRA. So SEP, this is going to be ideal for sole proprietors, obviously, or family-based partnerships or S corps if you've got like a two-person S corp and they're married, something like that, that can be beneficial. But the reason that this doesn't work well with with employers that have multiple employees is that what you contribute to this SEP, you also have to go and do the same for your employees. All right. So this can be this can be powerful for those folks. If you have employees, this can be extremely expensive. Some family-owned businesses like this because it's okay. They're keeping it within the family. They're happy with those contributions, but it can get very expensive if you have multiple employees. And we got a question here about that. So let's stop here. When you say best for businesses with employees, that's a good question. So is the owner an employee? So the simple IRA deductions would come from if you're an employee, then you can contribute to it as well. So this is going to be important for S corps. So if you pay yourself a salary, if you're on W-2, that's how you would contribute to the simple IRA. And again, the reason I separate that based on employees is that SEP generally isn't favorable for folks who have to match their own contributions to their employees. Okay. And the SEP contribution limit is going to be based on wages and profit. Traditional IRA, that's on the individual side. If you have already contributed to a Roth, they share the same contribution limit. So Roth, think more long-term tax advantage. You've eaten the tax in the current year. Traditional IRA can result in a deduction. So if you're an individual, you can contribute $7,000 in a year to a traditional IRA, and that just comes off the top of your taxable income, unless you're subject to phase out, which is possible. And we'll talk about that a little bit more here in a few minutes. Stop here for a question. We'll come back to that one. If you guys could help me remember to come back to Reese's question there when we have a little bit more time for questions. So just a little bit of a drill down here to SEP. Um, Employer funded. So this is an important note here. If you decide, and this of course, I would hope that a financial advisor would make you aware of this too before you signed up for it, but this has to come directly from your business account into the investment account. Okay. So this isn't, again, this isn't like a traditional IRA where you pull um, you pull the money into your personal account and then you send it to the custodian. This is different. This is going to ultimately just show up on your books for your business as a business expense. So you will be told by your custodian to write a check directly to the investment account. Okay. So there's no passing through of personal accounts. And again, 25% of W-2 wages. So um, a little bit limited there, especially for very small businesses. And again, the same percentage must be given to all eligible employees. And here are the kind of the parameters of what qualifies as an eligible employee. So if you've got um, all employees under 21, if you've got two employees that are under 21 and it's just you, then SEP can still work for you because you don't have to match your contributions for those employees because they're under 21. Um, they've worked for you for 3 of the last 5 years and they've got $750 plus in wages. And there's no vesting period here. And just a little bit of a note, we talked about the phase out for the traditional just to make sure that you're not contributing to a traditional IRA in hopes that it's going to save you in taxes and then it ultimately doesn't. Um, the big thing we want to look at here is, are you covered by a retirement plan at work? So if you are, then you are subject to phase outs. Okay. So these become your phase outs here if you're covered by a retirement plan at work. If you have a W-2 job, maybe separate from your small business, then at that point you want to look at these. If you're not covered, then you're not subject to phase outs at all. All right. I'm going to stop here for this question before we move on to equipment purchases. Are part-time seasonal employees eligible for the IRA? I think that is up to the company. So you can kind of set parameters of um, who's eligible for what and how long, before folks become eligible. But part-time seasonal employees should be eligible. I will put that slide back up. So the phase out is only, okay, Tiffany, the phase outs are only applicable to the traditional IRA, and that's an individual thing. This is separate from what you would do through your business. Okay. Um, that doesn't determine whether you're eligible for an SEP. Now, if you're covered by an SEP with your small business, then you are subject to these phase outs. You're welcome. And Ashley, is there a phase out if you contribute while not working a W-2 job? So Ashley, the question is whether you are covered by a retirement plan elsewhere. Okay. Nadine, I'm gonna ask that we hold yours until we get to the end here. Timing equipment purchases. This is again um, a huge conversation for me. Uh, most of the calls that I get at the end of the year are from folks that, you know, want to know if they can spend money to save money on taxes. Okay. And here's just a handful of just the general things that you might be able to deduct at the end of the year: computers, office equipment, tools, machinery, furniture, vehicles. These have to be purchased. The money ideally would leave your account before December 31st. All right. Assuming that most of the small businesses are on a cash basis, um, that's kind of the kicker there. It's going to be less defensible if you try to overlap years. Cash flow should ultimately trump your, anything else. It should trump tax savings. Your cash flow should drive primarily the decision of whether you purchase equipment. Okay. So if if you're a business that already has cash flow problems and you say, "Hey, we want to finance this new equipment," um, yes, that can really help you from an end of year tax liability standpoint, but you're going to be straining that cash flow continually based on that. So I would just ask that you prioritize your cash flow, your future cash flow, before trying to take a big deduction from an equipment purchases. And we'll drill in again a little bit to how those equipment purchases actually affect your taxes here shortly. Again, just cautionary tale here. Don't strain your cash flow too much just to save a little bit in taxes up front. And a little analogy for that is if you give me $1 with the understanding that it will save you 25 cents, you shouldn't have given me that dollar. Okay. So if you spend $50,000 on equipment, that doesn't mean that it's going to save you $50,000 in taxes, right? It's just a portion of that. It just reduces your taxable income. Okay. And the way that works, okay, Section 179, this is really powerful for folks who invest in equipment and finance it. Because at that point, if it's eligible equipment, whatever the cost, regardless of what, you know, how you pay it, how the cash leaves, you can deduct that entire cost. So, talking about magic wands, I'm hesitant to call this a magic wand because it seems to tempt people to go out and buy equipment. But this, if managed properly, if you know that you're going to have to buy a large piece of equipment within the next quarter, it can be very powerful to just kind of streamline that. Get it in the current year if you think you're going to have a higher tax burden than you anticipated, or maybe higher tax burden than you anticipate for the next year. The timing of these equipment purchases can be very powerful. You can't send yourself into the hole with this. All right. So you can't take a big loss. You can't just buy equipment and show a big loss based on Section 179 depreciation. All right. So you can take yourself down to zero, basically. You can't exceed that. The 2024 limit, I'm not that was probably meant to be the 2025 limit. 1.2 million. I think there are talks to increase that to 2 million. If you're maybe in manufacturing or something like that, that could be applicable to you. Bonus depreciation from your perspective as the taxpayer isn't going to look a whole lot different than Section 179. It's just another upfront depreciation acceleration for qualifying equipment. Now, this is most of the time Section 179 is taken first, but bonus depreciation is kind of the next step. If you do need to take your business and create a loss, all right, you can take yourself into the hole with bonus depreciation. All right. Quick little note on Section 179. You can really pick a dollar amount for, if You purchase a $50,000 piece of equipment, you can, in that first year, assuming the equipment is eligible for 100% Section 179, you can actually pick an amount anywhere in between 0 and $50,000 and take that in 179 current year and then amortize that out for 5, 7 years, however long the depreciable life is. All right. Again, capture your deductions. Okay. Just a few things here that are easy to miss. Make sure that you're breaking out the business portion of your phone and internet. Take advantage of the home office deduction if you have an exclusive dedicated space. Bank and credit card fees and things like that. So again, I like to just throw this in here periodically. As an accountant, bank reconciliations are extremely powerful. So get those processes in place. Make sure that you're capturing all this and capturing the things that come out of your bank account that are easy to miss. Mileage logs. This is a big end of year thing. Please please handle this throughout the year. All right. This doesn't trigger a lot of audits, but when it is audited, um, it's scrutinized. Okay. And it can be very hard to prove. I see these questions coming in. I'll once I get through this slide, I'll go back. Um, Date, total miles driven, business purpose, destination. It's going to look much more believable to the IRS if you have these in place and if you do it throughout the year. Um, if you just have 50 miles here, 50 miles there, 40 miles here, that's not going to hold up. It's just not. And like Ashley said below, there are apps that track this. I know that I personally use QuickBooks to track mine, and it will basically track wherever I go, and I just go through and select which ones are business related. Um, so yeah, try to do that throughout the year. It's possible to kind of factor in some mileage at the end of the year, but you're risking disallowed deductions there if a certain regulatory body ever decides to peek into it a little closer, right? There were some questions about this past one. So if insurance premiums again, that's really only going to be applicable to folks that have employees. I've got a client that has a really out of the kindness of his heart decided he has one employee, decided to pay for his insurance, and that's deductible, right? So this is going to be for folks with employees. Okay. What was the other question? I love this conversation that's happening. Professional fees would be, fees to get to um, have an accountant look at your business taxes, right? Or to look at your bookkeeping processes. Uh, Lawyers that set up your contracts, your engagement letters, things like that. All right, we're going to keep rolling here and we'll try to get what we can at the end as far as questions go. QBI, this is something that you probably, don't need to put a whole lot of thought into because it's pretty much baked into um, every tax prep software there is, right? But it's important to factor in if you yourself are trying to determine how much you owe at the end of the year. Um, you're going to want to factor this in. You can really overshoot what you're going to owe if if you don't factor this in. 20% deduction on eligible business income applies to sole proprietors, partnerships, and S corps. Subject to income limits, I apologize, I don't have that number right in front of me. Um, but again, this is something that's going to be baked in. It's pretty much automatically calculated by any reputable tax software. But just something to keep in mind if you're running projections. If you're helping, if Mr. ChatGPT is helping you run your tax projections, you might just want to mention, hey, make sure you throw QBI in there. Okay. Sarah, QBI, it's really just it's kind of a gift. It's just for sole proprietors, partnerships, and S corps. There's no, obviously, a massive company, C corp, wouldn't be eligible to this, but it's just a little bit of relief for small business owners, um, considering that small business owners are subject to self-employment tax. QBI is just a little bit of relief. Again, it's just a 20% deduction on eligible business income. LLC, LLC is kind of a different bucket here. Okay. An LLC doesn't preclude you from being a partnership. It doesn't preclude you from being an S corp, right? Actually, you're required to have an LLC to be an S corp. So, um, if you're asking if the QBI applies to LLCs, it does. Okay. It's more about the size of the business and the tax structure of the business. The LLC actually is not a tax structure. So, what can you do now? Okay. What can you do now to not only try to reduce your tax liability, but also set yourself up for success for next year? I'll say this a million times. Reconcile bank and credit card accounts. I know a lot of folks, credit card reconciliations can get a little bit weird, and a lot of folks just don't even include that on their books. Um, I would recommend end of the year, go through your credit card transactions if you haven't already and just see what's in there, right? See if there's anything you can pull over that's business related that you can deduct. If you're an LLC, you have a dedicated business account, just make sure that you reimburse yourself for any expenses that were mistakenly paid for with with personal credit card accounts, anything like that. Um, Of course, try to keep it all separate. Keep your personal and business separate. Again, especially if you have an LLC. You don't really have an LLC if you don't have a separate bank account, right? Make sure payroll is correct. This is a big deal. So, payroll tax penalties and interest can stack up rapidly. So, make sure that your payroll matches up to your 941s. Review owner distributions versus wages. This is specifically for S corps. Just make sure that you pay yourself a reasonable salary if you're an S corp before the end of the year. Just make sure that you kind of want to be half and half or approaching half and half with distributions versus wages if you are an S corp. All right. So if you need to bump up that salary at the end of the year, then you can put a little bit more in payroll taxes there and protect yourself. Save receipts digitally, protect yourself, and make sure that you can defend the deductions that you're taking. All right. Yeah, Nadine, if you're an S corp, a little bit more about distribution versus wages. So if you're just a sole proprietor, then you can pull money from your business account at your discretion. That's not what you're taxed on, right? You're taxed on the net income of your business. You're subject to self-employment tax and federal income tax on that. So if you become an S corp, okay, you are an S corp. So you're going to select a salary for yourself, and you want to kind of keep that half and half between. So if you're a single owner S corp, for example, when you look at your P&L at the end of the year, you want your wages to kind of be in a similar ballpark to what shows as the net income for your business, right? Um, there's I hate to say the word gray area because there is a right way to do everything, but uh, if you're making as a business $100,000 a year and you pay yourself $40,000 a year, that's reasonable, right? You're approaching that half and half point. All right. Does that make sense? And let me know if you have any follow-up questions. If you have your business charges on a business credit card, must you keep physical receipts as well? Yes, please. Please do that. Um, Now, if you have access to, if you feel confident that if it's somebody like Lowe's or Walmart and you have an account with them and you feel confident that you can get in and pull those receipts, I'm not saying you need to print all those out, but you need to be able to show an actual receipt. The IRS is usually not going to accept a statement again, unless it's just full of like corporation receipts that they know you could go and pull, right? So they're going to really hit you on receipts from local businesses, especially. Um, those are the most scrutinized transactions. So the answer to your question is, regardless of whether you keep the receipt physically or what have you, just make sure that you can access an actual receipt, whether it's electronic, whether it's an email, whatever. Just don't rely too much on the credit card or the bank statement. All right. Nadine, um, reasonable looking salary you pay yourself will be around 40K for a net income of 100K. Um, yes. On your P&L, your net income is not going to show 100K, right? We're assuming that the net income of your business is 100K before your salary. So the net income would show $60,000, right? Because your salary as an S corp is reducing the net income of the business. So you can, and the frequency with which you pay yourself, there's some discretion there. I personally recommend um, monthly is completely fine. Semi-weekly or monthly, completely fine. There are even folks that get away with paying it all at the end of the year because they don't know what they want to pay themselves until then. So, but monthly, I would much rather see that personally. How do you show office at home, phone, internet? So, Judy, if the home office deduction, the standard one, is $5 per square foot. So generally, for example, my office is about 100 square foot. I will deduct $500 for this office. So that will be the backup behind it is, is it exclusive to work? And what's the square footage? And if you ever get audited, they're going to look at the percentage versus your, and again, this is stuff that we would probably need to talk about one-on-one. There are thresholds that you don't want to cross based on the entire square footage of your home. Okay. But if you have a 100, 200 square foot office and you take the simplest deduction, which is just $5 per square foot, that's not going to raise a lot of questions. Okay. And internet and phone, you know, I, my business is baked in uh, pretty crazily with my personal life. So, um, and I still don't try to take more than 50% of my phone bill. We do have that under my personal name just because we get much better deals. So, uh, it's more about, how much are you trying to take? If you're trying to take 100% of your phone bill and it's also your personal phone, then that's not going to hold up, right? So that's kind of what. those deductions are based on. There's not really a, obviously you want to keep the receipts. You're going to be able to access those receipts if you need them for your phone, internet, etc. Right? So it's more based on thresholds that you don't want to cross. Okay. 50% of a, for a small business owner, 50% deductibility of your phone bill is completely reasonable. All right, just a little housekeeping here. At the end of the year, of course, you're going to have to issue W-2s and 1099s. Um, if you haven't refreshed your W-4s and VA-4s, um, might be a good time to do that. Judy, I'll get to you here in just a second. Um, refresh your documentation. W-9s before the end of the year, make sure that you have W-9s on file for all your contractors. All right. If you try to get those as we approach tax season, those contractors may not be so cooperative, knowing that you should have gotten them up front, right? Um, review again, I said this before, bump up your payroll to 941s. Make sure those are accurate. Yeah, all the end of year compliance boxes to check as an employer, just make sure you handle those. I really, debated whether I wanted to try to tackle this today. Um, 2025 changes leading into 2026. These are really, you could say, are more 2026 items. But I get a lot of questions about the big beautiful bill, and I am bummed to tell you that it's still very ambiguous. There's still very little guidance released from the IRS on this. But I think the big story to take away is that most of the Tax Cuts and Job Act implementations are continuing and or expanding, right? So that act introduced higher standard deduction. That's staying and will probably increase slightly. Okay. Child tax credit is staying. S corp taxability is staying, which is a big win. There were some questions about whether that would remain. So big win there. Bonus depreciation section 179 still hanging around. Again, just becoming a little bit more flexible. Uh, hopefully, possibly that's the proposal. Um, but those are still going to be around with maybe a little bit more expanded flexibility. Okay. And these are kind of more about the keepers, like what's staying based on the TCJA. Proposed changes are more flexibility for Section 179 bonus depreciation. They're trying to, or at least there are discussions about making smaller cars eligible for Section 179, whereas in the past it's mostly been for larger equipment, larger vehicles. And I actually had a question about tips yesterday, so I wanted to kind of put that in here last minute. If you're a small business, itemize your tips on the W-2s for your employees. I think there's some flexibility with that for 2025, but if your employees collect tips, make sure that those appear um, on their W-2s. A lot of the headaches that I think businesses are running into with this are unreported tips. So you're going to have employees that want the deductions for tips that are being proposed, but they didn't report them. So you can't really take the deduction unless you have a W-2 that shows your tips, right? So if you're a small business, just make sure that your employees have their tips tracked. Key takeaways. Look at this stuff throughout the year, capture all your deductions, understand retirement plans. Again, I see the most success with this when you work with a CPA, you work with a financial advisor, right? Financial advisor can handle more of the, um, I guess, compliance side of it. They can say, hey, are you eligible for it? This is how it's going to work. This is how the money is going to move. And then you can work with a CPA to make sure that, um, hey, this is how much this could save you during tax season. So if you could try to come at it with both sides, and if you're a business owner and you decide to work with us, then I would be happy to kind of run some of those projections for you. Okay. And when I say us, I mean SPDC. Okay. Um, Prioritize cash flow over tax savings. So don't purchase equipment just for the deductions. Keep your books clean. I'll say that a million times. Mileage logs, work on those throughout the year. Stay on top of your January compliance, 1099s, W-2s, things like that, and just keep up with the stuff throughout the year. Couple little links here that I'll just leave up while I answer questions. So I'm going to go through here and try to capture the ones that I missed. There were more questions than I thought there would be, so I apologize if I've overlooked anybody. So I think Lena just unmuted herself and she's going to help me see what I missed.
Yes, for sure. Um, I just wanted to say that I'm going to hop off in a few minutes. But just a reminder that we were waiting to respond to Nadine and Reese. And I don't remember, maybe some other questions might have popped up in the meantime. If you can resend your question, that's totally fine. And Blake, it's totally fine to go over our meeting time by a few minutes to cover questions. That's totally fine.
Sure.
So Olivia will wrap us up in the end, and I'll let you all keep answering questions. Thank you so much, Blake.
Thank you, Lena. Have a good day. I do see one here from Nadine about quick tip for percentage for phone and internet. Again, like conservatively, if you're a small business owner, I'll just tell you, I would do stick around 50%. How it shakes out for me. I would ask that you um, really break it down yourself and try to figure out in your brain how much you think is actually applicable to your business. But 50% is a generally pretty conservative amount that I see. Tanya, does the office space deduction only apply if you use the office 100% of the time? Yes. Yes, that is correct. It must be exclusive. I'm scrolling through here to see what else we got. Um, Judy, about whether you need to keep records on the phone and electric bills. Now, of course, if you have a business office, then those are 100% deductible, right? But if we're talking home, electric, and phone, um, for me, like I don't keep a physical copy of my Verizon bill, right? Because I know that that's in my Verizon account. Okay. So I can pull that and show it when I need to. Now, if you use some boutique provider that maybe doesn't have as robust of document retention, then sure, keep those invoices, receipts, or what have you. You just need to be able to substantiate it. And kind of similar with, I do keep my utility receipts just because our utility company is a little bit, more old school. So I do keep physical receipts of my utilities. So it's all about substantiating, and if you need to grab those receipts, that you can. Gina, I think I received a submission for you. We'll talk. If you're a small business and you're here, then we may want to filter you through the SBDC, but I will reach out to you separately. I did see your submission come through. It's sitting in my inbox, and I just haven't had time to get to it yet, but we'll be talking soon. What can be done if physical receipts get lost, destroyed, and cannot be replaced? That's a great question. Um, Documentation. So I would keep a log of timestamped that says, "Hey, this is what happened to it." So if something like that happens and there's just no way that you can get the receipt, if it's $10, you may just want to not take that deduction, right? But if it's more substantial and you can show where that money actually went out, go ahead and take the deduction. And if you need to kind of do a fire drill and explain, then at least you've got that documentation that said, hey, this receipt got destroyed at this point in time. Okay. How can we speak to a financial advisor? There are a lot of, you know, here's the thing. So, and it's kind of similar in my industry, right? Like when push comes to shove, we're going to take a look at your situation and we're gonna, webinars like this are difficult because we're trying to speak broadly, but in reality, it's all different, right? So the big thing you want to look at in a financial advisor, they're all over the place. Find somebody that's going to develop a relationship with you, that's going to discuss things with you, because they're all going to do a similar process. Hopefully, if they know what they're doing, uh, pay attention to the fees, of course. Most of those range if you're working with a local financial advisor, 0.75 to like 1.25. Pay attention to that. I don't know how this would work if you guys, I would be happy to point you to financial advisors, but I don't want to, step on any toes here with the state. So maybe that's something that down the line I can discuss with Lena to see if we can filter you to some of those. Um, but yeah, like I said, financial advisors are all over the place. If you find somebody local that you can discuss things with, that you feel comfortable with and develop a relationship with, that's going to be what separates them from one another. And just make sure the fees are kind of falling between that 0.75 and 1.25%. All right, Valentina, if you're a W-2 employee and have your own LLC that is generating revenue, how does the cap work for investing in an IRA account? Sorry, I'm thinking about that. So you've got the 401k, so you're subject to the phase outs. All right. And that's going to be based on your taxable income. So let's just go back to that. Um, here are the numbers here, and that's going to be based on your taxable income, right? So if you're single, you're going to start phasing out at 77,000 and you're going to be completely phased out at 87. If you're married, here it is. If you're married and just one of you is covered by a workplace 401k, the phase out is pretty large here. Um, so I'll just leave this up here for a minute and let you kind of look at that. So you are subject to the phase out if you're covered by a 401k. All right, Tracy and Wesley. What is your recommendation for a small business, 200K or less in sales each year to get continuing guidance on business practices, tax advantages, planning? Um, yeah, that's a great question. Um, so are you saying that your current firm, your current accounting firm doesn't do the tax planning and strategy and things like that. If you qualify as a small business, I'm sure that we could help you with that through SBDC. I'd be happy to meet with you and help you with some of that stuff. If you would like to go through the channels. Is the phase out also apply to someone who is no longer a W-2 employee and how now has a business? If you're not covered by a workplace plan, then you're good. All right. Now that is a good question as to whether I'm going to put. I hope this is okay. I'm going to put my email address in here. Um, Tanya, if you want to copy and paste that in an email and send it to me, I'll just respond. Just to make sure that if you were a W-2 employee at some point during the year, I just want to make sure that that doesn't preclude you. So I just want to look at that. So once you hit that phase out cap, you are not allowed to contribute to a personal IRA through your business. You can still contribute. It just won't be a tax deduction. That's what the phase out is for. You can still contribute. It just won't be a deduction. Did we get everybody? I think we did. All right. Well, I'm all finished up here, Olivia, if you want to close us out.
Alrighty. Well, thank you so much, Blake, for your time today, and I look forward to future sessions with you. We are coming to a close. Again, if you were not able to respond to your question, send us an appointment request through our email, and we will ensure to help or connect you to resources that can help your business needs. Thank you very much, and we hope to see you all in a future webinar and events.
Thanks, Olivia.
Thanks. Y'all have a
Bye-bye.
Merry Christmas.